It's bilateral trade balances that really concern President-elect Trump, and I think that we will see a moderation perhaps in the language. And as you say, it's early days. It's very much wait and see. But for sure, the pressure globally on the "Making America Great" election slogan means that the rest of the world has to give up something. And so let's see how that plays out.
Yeah, just saw a note out from Nick Ferris from Vantage Point this morning saying, make volatility great again. So that is something that I think many investors and traders are sort of bracing for right now. But John, how are you looking at this through the lens of the Fed and the next moves now? Because, of course, the other event risk on the horizon is the FOMC and, of course, the easing cycle more so next year.
Absolutely. Rate expectations have come off a little bit. So overnight, market implied policy rates have down by about 15-20 basis points. So the terminal rate of the Fed that we had expected was about 3.5%. That's probably more in the order of 3.75. Two-year yields are trading at 4.25. But rates had backed up the last couple of weeks quite substantially, 60 or 70 basis points. We do think for sure there's a curve steepening. But in terms of the Fed, we would expect the Fed to continue to prosecute their agenda as long as inflation remains on the right path. And of course, this is more structurally now what's been thrown into question because tariffs are inflationary. So we will see how the Fed react. We do expect that they will do a 25 basis point cut this week, possibly another 25 in December. And then we will see the path for sure is more shallow. And this has implications, of course, for emerging market central banks as well. In an environment where the Fed was not going to be as aggressive and financial conditions were not going to be as easy. This has implications for the rest of the world, and hence the different response, I would say, to risk assets in APAC this morning.
John, let me throw in the deficit as well. And there is a perception that Trump's fiscal spending plans are going to be far more aggressive than Harris's. Ultimately, does this mean that benchmark 10-year yields revisit 5%, possibly even higher, and we in APAC have to contend with a stronger dollar that goes along with the ride?
Indeed. I mean, the direction of travel is all in that direction. The narrative, the longer-term narrative about the U.S. fiscal situation has been negative, but it's been negative for a long time. So we know that the Center for Budget Responsibility in the U.S. has published long-term projections showing that the deficit dynamics will disimprove substantially. You're right when you say that a Trump presidency was going to be more fiscally profligate versus a Harris presidency. But it's one of the areas where, irrespective of who had won the White House, the fiscal position of the U.S. was going to deteriorate somewhat. So that does put pressure on longer-term bond yields. We've already seen yield curves steepening. We think that trade will likely continue. But bond markets have preempted some of this in the recent pricing. That does put pressure, as you say, on the dollar interest rate differentials. We can see the currency moves overnight with the yen falling, dollar up, euro down. This puts pressure on Asia FX. It puts pressure on Asian central banks. And look, these are long-term things, and we'll see how they play out. And I think that the inflationary impact, the tariff impact, will take a long time to play out. But certainly the knee-jerk reaction that we see, the sugar rush rally to risk assets, we can expect that to continue, I would say, in the short term.